Hi, I'm Ross Mayfield, investment strategist at Baird, and we are back for another weekly update with our friends at Strategas. Today, we are lucky enough to be kicking off the new year with Chris Verrone. Chris is a partner at the firm and heads Strategas' macro and technical research efforts. Chris, how are you doing today?
I'm doing great. Happy New Year, Ross.
Yeah, absolutely. Appreciate it. Same to you. And let's, in that vein, kick this first episode off thinking about the new year. You know, we ended 2024 on a bit of a down note, even though the year finished quite strong, with December being unnaturally weak. However, you wrote recently that January performance is actually much more important than December for how forward returns look. Could you break that down a bit for us?
Yeah, it's an important question, especially considering that it was a weak December. I mean, if you look back to 1950, historically, December is a positive month about 75% of the time. So rare to have a down December as we did this year. But what we find curious with the data is if you're thinking about future performance, say next 6 months, it's not December that has an outsized impact on the next 6 months. It's actually January. January is a much more significant month in setting the tone for what the kind of next 6 months will look like. So what we found in our work is a weak January has historically not proved too good for future 6-month returns, whereas a strong January has. So it's an important month here. We're off to a decent start thus far in January. I would like to see this broaden out here a touch. It's been a relatively narrow move to start the year, but nevertheless, an important month for setting the tone.
Yeah, and as we think about how the market is looking at the beginning of 2025, you know, weak December, bond yields rising, as you mentioned, breadth, not all that impressive. And yet you also concluded that leadership still looks okay. Could you break down the leadership profile?
Yeah.
And then maybe just like, why is that important to you? What does leadership mean for the rest of the market?
Sure. Well, I would say kind of at the highest level, we look to the leadership to kind of dictate or tell us what the character or the tone of the market is. Is it pro-risk or is it anti-risk? And that's one of the unusual things of the last few weeks. We've had this environment where bond yields have moved higher, really to the point of this 460, 470 zone where it makes us uncomfortable. We've seen some softening in the breadth and in the internals, but what we haven't seen is any real meaningful knock or change to leadership. And by that, I mean stuff like consumer discretionary is still outperforming consumer staples. Financials have largely held their own. So you're not seeing some of these weakening internal conditions be met with some complete reversal to the market leadership. I think in particular, the financials are really important here. They've been a very important part of this market for the last year. And I think certainly if we're going to sustain the status quo, it's important we keep them involved.
Yeah, absolutely. And cyclical leadership remaining solid and then credit spreads remaining tight. Two things to watch really closely in this first month of the year. I want to get your take on one other indicator that has been moving pretty wildly and has, had a big impact on a lot of the other macro, which is the US dollar. It's an outlet for, trade thoughts, for tariff thoughts, for tax policy thoughts. What are you seeing out of the dollar and how do you handicap what it does the rest of the year and then what that means down market?
So I'll make a couple points on this. I'd say number one, if you look at the dollar's performance since the election, we're almost tracking to the tick of what the dollar did post 2016 Trump win. So I know it seems extreme here the last 6, 7, 8 weeks, and it has been from a rate of change perspective, but it's actually not too dissimilar from what we saw coming out of that 2016 period. Now, the second point that I would make here is the velocity of this move. The 3-month rate of change in the dollar is at about the 95th percentile historically. That has historically not been great for future S&P returns. You don't get negative returns from that condition, but you have historically seen returns below average. So I just want to be mindful of that. It's only one input. It's only one macro consideration here, but the historical track record has not been great for future S&P returns from that. But third, just keep in mind on the sentiment front, everyone is suddenly a dollar bull. We looked at this in our work actually this morning, looking at dollar sentiment. It's in about the 95th percentile historically. So everyone's a dollar bull. When you get one-sided sentiment or one-sided thinking, you just want to put yourself on guard for some type of a reversal or some mean reverting price action. I think equities would certainly welcome some weakening in USD here.
Yeah, absolutely. U.S. equities and international equities in particular, which tend to be get a tailwind from a weaker dollar. So, Chris, this is a great setup heading into the new year. I'm looking forward to getting to talk to you again as it goes on. But thank you so much for the time today.
You bet, Ross. Take care.